You've heard it your whole life, probably from a relative at a dinner table said with total confidence, renting is throwing money away. It sounds obvious. When you rent, your money leaves and never comes back. When you buy, you're building equity. You actually own something. Case closed, right? Here's the problem. That sentence is half true, and the half that's missing is exactly the part that costs people the most money. Because when you own a home, a huge chunk of what you pay every month also vanishes. It doesn't build equity either. It's just gone. We'll get to exactly where it goes. I'm not here to tell you renting wins or buying wins. Anyone who says one always wins is selling you something. What I'm going to give you is the actual math, the costs nobody puts in the brochure, so you can run the numbers for your own life. This is Money Mechanics, how money actually works. And today we settle the rent versus buy fight, honestly. Factor 1, the hidden costs of owning. The money that disappears even when you buy. Let's start by busting the myth properly. The idea is that a mortgage payment builds wealth and rent doesn't. But a mortgage payment is not one thing. It's several things bundled together, and most of them don't build a cent of equity. First, interest. When you borrow money to buy a house, you pay the bank for the privilege. And here's the part that surprises people. In the early years of a mortgage, the vast majority of your payment is interest, not principal. Remember back in video 3, when we talked about how loans are front-loaded? Same thing here. In year 1, you might pay your lender thousands of dollars in interest, and only a small slice actually goes toward owning more of your house. Interest is rent. You're renting money from the bank instead of renting space from a landlord. The relationship changes, but the money leaving and not coming back part doesn't. A renter writes a check to a landlord. A new buyer writes a check to a lender, the tax office, and an insurance company. In both cases, a big share of the money is simply the cost of having a roof over your head this month. Then there's property tax, money you pay the local government every year, for as long as you own the home. It never stops and it never becomes equity. Insurance. Lenders require homeowners insurance, and you pay it monthly or yearly. Gone. And maintenance? The big one renters forget. When you own, you are the repair department. The roof, the water heater, the furnace, the surprise plumbing disaster at 2 a.m. A common rule of thumb is to budget roughly 1% of the home's value per year for upkeep. So on a $300,000 home, that's roughly $3,000 a year. Averaged out, that just keeps the place standing. Add it up. Interest, taxes, insurance, maintenance. For a new buyer, a big portion of the monthly check is money that doesn't build equity. Just like rent. The honest version of the saying is, some of every housing payment is thrown away. The question is just how much and where. Factor 2, opportunity cost. The money you don't see leaving. This is the most invisible cost of all, and it's the one that flips the whole debate. When you buy, you usually need a down payment, a big chunk of cash up front, plus closing costs, which are the fees to actually complete the purchase, lender fees, title fees, paperwork. Those run roughly 2 to 5% of the home's price. On a $300,000 home, that's somewhere around $6,000 to $15,000. Gone the day you sign, before you've built any equity at all. But here's the real question. That down payment, say $60,000, what else could it have done? This is what economists call opportunity cost, the value of the best thing you gave up. If that $60,000 were invested instead, it could be growing. Remember compounding from video 5? Money that earns returns and then those returns earn returns. Locking a large sum into a down payment means that money isn't compounding somewhere else. Now, this cuts both ways. The home itself might appreciate, might grow in value, but it might not, and it's not guaranteed. The point isn't that investing always beats a house. The point is that the down payment isn't free just because you can't see it leaving your account. It has a cost, and honest math has to count it. This is the cost the dinner table version of the saying completely ignores. It treats your down payment as if it's safely in the house, and therefore working for you. But money locked in a house is money that isn't doing anything else. That trade-off is invisible. It's silent, and for many people, it's the single biggest number in the whole decision. Factor 3, time horizon, the break-even nobody mentions. Here's a number that changes everything. How long you plan to stay. Buying a home comes with huge one-time costs. We just covered closing costs going in, roughly 2 to 5%. But there are also costs going out. When you sell, you typically pay agent commissions and fees that can eat another chunk, often several percent of the sale price. So buying is like a deep hole you start in. You have to climb out of those transaction costs before owning even starts to pay off compared to renting. As a rough illustrative guideline, many people find buying needs around 5 or more years to come out ahead, purely because of how big those one-time costs are. If you're going to move in 2 years for a job, a relationship, a city you're not sure about, buying can actually lose you money, even in a decent market, because you never climb out of the hole. In that situation, renting isn't throwing money away. Renting is the financially smarter move. Notice what just happened. The same decision, buy a house, is a great idea for one person and a costly mistake for another. Same house, different timeline. That's why renting is throwing money away is too simple to ever be true on its own. Factor 4. Flexibility versus stability, the part that isn't math at all. So far, we've talked dollars. But this decision is also about your life, and pretending it's pure math is its own kind of mistake. Renting buys you flexibility. If you lose a job, get a better one across the country, or just want to change, you can leave when your lease ends. You're not the repair department. Your costs are predictable. The landlord eats the broken furnace, not you. Owning buys you stability and control. Your housing cost can be more predictable over the long run. You can paint the walls, knock them down, get a dog without asking anyone. For a lot of people, that sense of permanence is worth real money. And that's a completely valid reason to buy. This is where the math has limits. A spreadsheet can't tell you how much it's worth to stop worrying that your landlord might sell, raise the rent, or not renew your lease. It also can't tell you how much flexibility is worth when your life is still moving fast. Those are real values. They're just personal ones. So put a number on them if you can. And if you can't, at least be honest that they're sitting on the scale. Neither of those is wrong. A 26-year-old who might move 3 times this decade and a 38-year-old planning routes for the next 20 years are answering different questions. The math matters, but so does the life the math is supposed to serve, the PERS. Factor 5, the 5% rule, a quick mental shortcut. Okay, you want a fast gut check without a spreadsheet. There's a popular mental model some people use called the 5% rule. It's rough, a back-of-the-napkin tool, not a precise answer. But it's useful. The idea, take the price of a home you'd buy, multiply it by 5%. That rough figure is meant to capture the yearly non-equity costs of owning, bundling together things like property tax, maintenance, and the opportunity cost of your money, the stuff that doesn't build equity. Then divide by 12 to get a monthly number. Now compare that monthly number to what it would cost to rent a similar place. If renting is cheaper than that number, renting may make financial sense. If renting costs more, buying may come out ahead over time. So, on a $300,000 home, 5% is $15,000 a year. Divided by 12 is about $1,250 a month. If you could rent something similar for less than $1,250, renting is doing fine. If similar rentals cost more, the scale tips toward buying. Again, illustrative. Your taxes, rates, and local market change the picture. But it's a fast way to stop comparing your rent to a mortgage payment alone, which is the mistake that started this whole myth. So let's bring it home. 1. Owning has hidden costs. Interest, taxes, insurance, and maintenance don't build equity. A mortgage payment isn't all savings. 2. Opportunity cost is real. A down payment, locked in a house, is money not compounding somewhere else. 3. Time horizon decides a lot. Transaction costs mean buying often needs around 5+ years to beat renting. 4. Flexibility versus stability is a life question, not just a money one. 5. The 5% rule gives you a fast, rough gut check. Here's the honest takeaway. Renting is not automatically throwing money away. And buying is not automatically building wealth. Both have money that vanishes, and both can be the right call. It depends on your timeline, your finances, your market, and your life stage. Run your own numbers. Don't run on a slogan. And remember, this is education, not financial advice. The goal isn't to tell you what to do. It's to make sure you can see every cost before you decide. If this changed how you see that old dinner table line, do me a favor, like subscribe, and drop one word in the comments, renting or buying, and where you are in your decision. Next time, we're tackling the question everyone asks after this one: how to actually start investing for total beginners. No jargon, no minimum net worth required. I'll see you there.